Hello everybody, good morning, good afternoon, and good evening depending on where you are in this amazing world. My name is Donovan Jolly, and welcome everybody once again for another amazing video of DIY investing. For today's video, I'm going to be teaching you guys about the CPI and exactly what is the Consumer Price Index. This is what is ultimately causing the markets to sell off. Anytime the stock market sells off, it drags crypto with it, and all of these sell-offs have been directly correlated to every single CPI report that has been released. We just barely got the release of the new report. This has caused the markets to pull back. I'm going to be teaching you guys what this means for the long term, what we could expect to see, and most importantly, what is the cycle bottom going to look like for this major correction. If you're new and just find this channel, always remember to do me a favor by leaving a like, comment, and subscribing to this channel for more updates. Always remember to click that notification bell so you don't miss out on any of these amazing videos like the one provided for you here. And make sure you guys sign up and join the Discord server or download my free ebook. Links are going to be provided for you in the description for both. With that being said, we got a lot of really cool things to cover today, so without further ado, let's jump right into it. Now, I don't really care a lot about the short-term price action. The things that I think that matter most on what is ultimately going to cement a bottom or give us that reversal that we're looking for is going to be the CPI. Now, for you guys that do not know, this is ultimately what gauges the consumer index of the prices, whether it's food, whether it's any single thing inside of our everyday lives. All of this is going to be categorized inside of this report. And so what we've noticed is every single time we get a new update inside of this CPI report, the markets sell off. Now, why are the markets selling off about this report? Well, it's just simply because the inflation keeps going higher. And so if we come down here, we can see that this is just a 1 month change for the CPI, and this goes all the way back to May of 2021. So this is an entire year. And it ranges pretty much from 0.5 to about 1. And that's kind of what we've seen. Anywhere from 0.7, 0.9, 0.5, 3, 4, 9, 7, 6, 6, 8, 1.2, 0.3, and then 1. So really, guys, inside of this calendar year of 2022, we've had some pretty high inflation numbers. I mean, regardless, all of our numbers prior in the prior year of 2021, they were pretty high. But, you know, in the last 4 months, we've already seen one of 0.8, 1.2. April was really low, but now in May, we can see that we're already back up above 1%. And so these are pretty high numbers. I mean, for inflation to be jumping up 1% within just 1 month's time. And then when we look back here and we can see that this is not the first time we've had many of these increases. This is a huge increase inside of inflation. And we can see that the inflation just keeps going higher. If we come down in here, you guys can see a little bit of how the data is ultimately comprised inside of giving us these earning reports. We can see food at home, away, energy, energy services, electricity, utility, gas services, commodities, new vehicles, used cars, apparel, medical care, shelter, transportation, medical care services, things of that nature, right? It's literally everything in our common day life. And with inflation going higher, we're actually in this period where we're seeing, inflation going higher and our asset prices going down. So what does that mean? Well, it's literally just a period of deflation. Now, for you guys that maybe don't know what deflation is, let's talk about inflation. Well, inflation is when they're printing more money, there's more and more stimulus coming in, whatever it might be. Maybe it's just, maybe it's just the Federal Reserve printing money, or in the last couple of years, we actually saw something new happen, and that was where all of the stimulus got printed. Well, fast forward a couple of years, because of all of the influx of new money being printed, all of the new dollars that were created, the asset prices momentarily actually start to pick up, and that's what we saw with Bitcoin, right? Pretty much down here, this was COVID that we saw during this crash, and then shortly after is when we started to see the money printer starting to go into effect. It wasn't coincidence that Bitcoin immediately skyrocketed after that took place. Now, it was shortly after this period we got our first correction, and then it was during this second attempt at a breakout that we actually stopped printing entirely. We actually went into a period where the government and the Federal Reserve was no longer going to be printing any new dollars. And this was really the first time that had happened since pretty much 2008. And so the entirety of Bitcoin's trend had only been going up during a period where the Federal Reserve was printing more US dollars. And so this was a really big testament to what could potentially happen for Bitcoin in the short term as well as the long term. And we can see that the second that they turned off the money printer, Bitcoin started to sell off back down. And so during this period, this is actually what goes into a new transitory period where the money printer was printing more money. Because of this, asset prices were going up. Now, what happens if we still get inflation, right? The inflation is still going up, but instead of the asset prices also going up, we're actually seeing the asset prices going down. And that's exactly where we're at today. The money printer has stopped, but inflation is still going up. With inflation still going up and the money printer turned off, we're actually seeing the asset prices going down. And so this is a period of deflation. Anytime the asset prices are going down, but inflation is continuing to rise, that is what is known as deflation. And this is really the first time in which Bitcoin has had to go through one of these major periods, specifically being that we don't have the Federal Reserve printing new stimulus, adding new money onto the open market. We are now pulling back from that. And so this is the first time Bitcoin has ever had to go through that. I don't think that it's coincidence that Bitcoin would pull off from that. I think that it would make sense, especially with all of the different catalysts inside of our market today. It's no coincidence that Bitcoin is heavily correlated to the equity markets and the SPX. We know that Bitcoin is just following the stocks. Whatever the stock market's going to do, whatever the equity markets are doing, Bitcoin is going to be following. Now, I do believe that long-term Bitcoin will distance itself from the equities. Bitcoin will be its own sort of store of value, but I don't believe that we're quite there at that point. And with Bitcoin pulling back and showing such correlation with the equity markets, I think that that's pretty apparent that, hey, we're not quite ready to be mainstream adopted. We have some period of time to go about before we get to that point. But in the same argument, people have been saying that Bitcoin could never be a store of value. It will never be widely accepted to the likes of gold. But when we look at gold, gold is actually down against the dollar. Gold is down on inflation over the last couple years. Ever since we started having tons of stimulus, ever since we kind of went through this entire period over the last couple years, gold actually has gone down in value against the dollar. So Bitcoin is up in value against the dollar, whereas gold is down against its value in the dollar. So if Bitcoin can't be a store of value, then why is gold a store of value if it's actually doing worse during a period where it's supposed to be doing much better? We have record inflation. During record inflation, we would expect that the hedges on inflation, being gold, would do well, which in fact it is not. And so it's too small-minded for us to say, okay, Bitcoin could never be a store of value just because we're now heavily correlated with the equity markets. Correlations happen, and they are going to fail time and time again. And one of the big things I want you guys to remember here is I've gone ahead and made this chart to help factor in when is a bottom going to be taking place, right? Now, first things first, I think that the bottom is ultimately going to be decided once the SPX stops pulling back, right? We have this S&P 500 index. Every single time we've sold off, we've made lower lows and lower highs. This lower high came right amongst the resistance, our previous support, and we rejected and made another new lower low. Once again, this rejected off of our previous support. And now we're rejecting off of our previous support once again. So most likely this is going to resolve to the downside in the same way that this did, in the same way that this did. All of these are lower highs. And so unless this drops and then bounces back up and does something like that, there's no real reason to suspect that this is just going to keep going up. The direction of the trend is down, and so by default, most likely the trend is going to continue to resolve down. And so I think that ultimately Bitcoin is going to find its bottom once the stock market finds its bottom, wherever that is, whether we go for another low or whether we end up building out some sort of a range here before finally breaking up higher. I don't really know, and it doesn't necessarily matter, and I don't care a whole lot. What matters to me most is knowing that because of this correlation, Bitcoin most likely isn't going to bottom until the SPX bottoms. And so we need to be watching for when the SPX is actually going to cement its low. As of right now, there's really nothing that's giving us a clear understanding or direction on when that or where the market's going to take. And so we're just going to kind of brush this aside and move on. Now, let's talk about our final chart for today's video, and let's kind of factor in our Bitcoin halvings. We're getting fairly close, not super close, but we're at a point where historically we have seen bottoms inside of Bitcoin. And so how does this factor in with the Bitcoin halving? We know that the Bitcoin halving has been the biggest driver of value inside of Bitcoin since the inception. And so it's important that we understand how these halvings actually factor in with Bitcoin bottoms. So we're going to go over here. Every black dotted line indicates the beginning of the Bitcoin halving or the bottom of a bear market trend. And so in this case, the first one over here was our first Bitcoin halving that occurred some point in the middle of November, right? Give or take about a week. Now, if you measure from the halving all the way down to our cycle low of the bear market, our first cycle was about 784 days. From the Bitcoin halving to the cycle low equaled about 784 days. And then after that 784 days, Bitcoin went in through a range, right? This is the 2015 bear market bottom, where we pretty much consolidated sideways for 280 days before then beginning our new uptrend beginning of 2016 and then taking us into the 2017 bull run. Now, once again, let's take this and let's analyze how this kind of applied to our most recent bear market. And let's take it from our halving in 2016, which occurred about July 4th. And then we go all the way to our bear market bottom, which occurred here December of 2018. This one added about 100 days. We get to about an 889 day consolidation from the halving to our bear market bottom. Now, once again, if we apply pretty much the same rule of thumb from our cycle low during our accumulation period, this one went through a much lesser accumulation. This one was only about 126 days. But we can see, once again, pretty right on par. We get close to 800 days of consolidation. That equals our low. Bitcoin goes through 280 days worth of sideways accumulation. And so really where we lost 100 days during the bull run to the bear market bottom, we pretty much equaled out because this bottom in 2015 added 100 days, whereas this one subtracted 100 days. The bull run to the bear market bottom was 100 days longer, but the consolidation was 100 days shorter. Whereas the bull run to bear market bottom was 100 days shorter, whereas the accumulation was 100 days longer. So at the end of the day, guys, one of the big things with time frames, they always end up balancing themselves out. Maybe you get a little deviation on one side, but on the other side, usually it will balance itself out. You'll think that, oh, because it went this many days in one direction, it will probably translate to the same amount of days. Generally, that doesn't happen. Whereas if you get kind of a leniency to one side, maybe we get a much deeper period where you notice how we went through an extra 100 days between the cycle from the beginning of the halving to the bear market bottom. This added 100 days. But where we added 100 days, we pretty much subtracted 100 days worth of sideways accumulation that we would have expected to see, right? If we're comparing it to this cycle, we may have lost 100 days in our bull trend cycle, but the sideways accumulation added 100 days and then pretty much lined us right back on par with the prior trend. And this is something that happens oftentimes. And so as we're getting ready for this cycle that we're in today, trying to figure out when and where we could find a bear market low, I think it's important to understand this pattern. Now, we know that our last halving was about May 11th of 2020. So historically, let's draw 800 days worth of consolidation here. And then let's draw another line. This should give us an idea on approximately where we could see a bear market bottom, where we could see the beginning of our accumulation trend. And we're going to go back here and look. So in our first cycle, it was about 784 days from the halving to the bear market low, followed by 280 days worth of accumulation. Then we began the new trend. We added 100 days worth of consolidation inside of our next bull run to the bear market bottom. But then we subtracted 100 days in our accumulation range. Doesn't really change anything. We start the new trend back up once more. Now, if we measure, once again, from our Bitcoin halving, and we go 800 days in advance, notice how our sell-off, we're about 75% down from that high. Notice how where we're at is coming right, once again, in contact with that same 800-day threshold. So, we could bounce anywhere from about 784 days all the way over here to about 900 days before we find a true cycle low. If we bounce all the way over here to 900 days, we'd be looking at about October as our cycle low, which really would be following a lot closer to the 4-year cycle timeframes, right? If this stretches all the way out to about 900 days from the Bitcoin halving to our cycle low, then really we're just going to be following the 4-year cycle timeframes because, once again, 365 days from our cycle top is going to be taking us to about November the 7th. So just barely a month longer than what this is showing. And so these are a couple different factors and data points that we can pull off of. Historically, what we've noticed that the time it takes from the Bitcoin halving to the bear market low equals anywhere from about 800 to 900 days. Well, we're pretty much sitting right at that 800-day threshold once again. And so I think it's time that we're watching for when and where our accumulation range is going to be taking place. What is that accumulation range going to be looking like? You know, it's really hard to say. But what I will say is that I do believe that we're very close if we haven't already found a low. Whether this bottom of the candle wick was our low, or whether we kind of come back down and go slightly lower or just retest it, I don't think it changes a whole lot. Regardless, I just find us going through a pretty lengthy consolidation until we end up building an actual base. You know, it's probably going to look quite a bit different than this. My guess is it would look a little bit more similar to this move here. But the big thing that we need to remember here is the time frames are going to differ. We don't know how long it's going to be. We don't know if it could be a short little V-bottom similar to COVID. I think that the current market conditions are different than COVID, and so I'm not expecting, you know, this type of a move and then into a new bull run. I'd be expecting a lot more of a choppy, slow, you know, methodical consolidation. This is much too long than even what I would be expecting. But, you know, if we came back down, retested the wick, we kind of bounced up, made a lower high. You know, we could stitch in something along the lines of this, and it could form, you know, a hybrid cycle. Really nothing different than what we've seen in any of the prior bear markets. The big thing that we need to remember here is it's just going to be kind of a choppy period. This is the period where all of the volatility dies out. All of the people that were really just here to make a quick buck, they leave. There's really no point, unless everybody's making a lot of money, to stay through the sideways range. If you don't have money to rebuy the dips, then most everybody just leaves awaiting to buy the next cycle top. And so here's the big thing I want you guys to remember. With us being right here once again at that 800-day threshold, historically this is where we've marked the beginning of the cycle low and the beginning of the accumulation range. And so if this is to be expected, you know, most likely I really am not expecting a lot until the end of the year. I think that most likely what Bitcoin ends up doing is providing some type of foundation, some type of accumulation range like we did here, like we did over here. That's kind of what I'm expecting pretty much throughout the rest of this year. I'm not saying that we can't go a little bit lower. We could make a new low. We could come all the way back down and retest in the mid 17,000s again. Anything's on the table at this point. But I do believe that it's at this point in which we're going to start seeing a base, a foundation, before we begin the next bull run that's going to be beginning, you know, basically 2023. Some point at the end of this year, that's where we could be looking for the cycle low as well as the beginning of the new cycle. And so I wanted to give you guys this update as just a way to factor in some other data points. Our halving is very important. Our halving historically has been a pretty big point in understanding where our cycle low could be. And now that we're at that exact same point of the last cycle, anywhere from about 800 to 900 days, that's where we could expect to see somewhat of this range being built. And so now that we're here, guys, I think that the likely scenario is for us to just continue to stick to our bets, continue to stick to our accumulation, or if you're just holding throughout this period, that's once again going to be the best thing to do. You don't want to be getting chopped up and selling during this period where things are just really going to be getting slow. Probably not going to be a whole lot going on for the rest of the year. But during these times, it's important that you can develop another strategy. Learn how to day trade. Learn how to make another source of income. Do anything that you can to accumulate more crypto, because it's in these periods of time that are going to prepare us the most for that next big bull cycle. If you're someone like me that really is just here for the long term of the cycles, has a few cryptos that he likes to hold long term, that's really what I like to do for the most part. I have a few cryptos that I think are going to be the most key for the long term, and I like to stick to those, accumulate those during the dips, and during these periods inside the bear markets, these are the most opportune times. And so anyways, guys, if you found value in this, leave a like, comment, and subscribe. Hit the notification bell so you don't miss out on any of these amazing videos. If you guys want to join the Discord server or download my free ebook, links are in the description for that. You guys can also sign up for my video course and signals, follow all the trades that I take, copy all my trades, all my expert picks and things of that nature. Links are in the description to go ahead and sign up on my website. With that being said, thank you guys so much for tuning in, and I look forward to catching you in the next video. As always, peace out.